So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity is coming into the market. Some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. Yeah. So we've got a really nice period ahead of returns. Don't forget, step back, all of the noise you read, all of the stuff, rates are at 5.5%. Headline CPI is at 2.5%. Trueflation, which I think is built on Chainlink.
Yeah, that's right.
Is at 1%. Right? Rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great.
The U.S. Federal Reserve delivered a much-anticipated rate cut on Wednesday, lowering its benchmark interest rate by 50 basis points. This was the first such announcement since March 2020. Before Wednesday's meeting, there had been much speculation about whether the committee would deliver a 25 or 50 basis point rate cut, with most analysts predicting only a 0.25% rate cut. In its press release, the Federal Open Market Committee said, "In light of the progress on inflation and the balance of risks, the committee decided to lower the target range for the federal funds rate by 0.5 percentage points to a range between 4.75% to 5%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks," the FOMC added. Global market participants, from investors to traders and fund managers, have been anticipating this precise moment since the central bank started hiking rates at the fastest pace in history in 2022. According to Real Vision founder and CEO Raoul, this marks the beginning of what he envisions will be very profitable months for the global markets. With the Fed delivering its first larger-than-expected rate cut before the November elections, Powell is certain that global liquidity conditions are about to take a very favorable turn for asset prices, while the renowned macro analyst and former Goldman Sachs executive predicts that all asset classes will benefit from the coming liquidity pump. He maintains that tech stocks and crypto, the only asset classes that have managed to significantly outperform the Fed's balance sheet, will benefit the most. Powell is predicting no less than a quadrupling of crypto asset prices before the end of 2025, from just a little over $2 trillion to $10 to $15 trillion next year, and $50 to $100 trillion by 2030. The Real Vision CEO recently shared his analysis on the current state of the markets and what to expect going forward during a fireside chat at the Enterprise Cayman conference on Tuesday. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching and enjoy the video.
So how I look at markets is I use a combination of the long-term secular trends, what things are trending over time, then the business cycle, and then liquidity. And I found over the years my framework's been adapted as I've understood more and more that liquidity has become almost the total driver of returns. And then you get some excess returns for secular trends. When you break down what I mean by all of that, the business cycle, as we know, goes up and down. You can use the ISM as a way of understanding the business cycle. We're currently at the turning point of the business cycle, where on a forward basis, we should see the economy improve. So the calls of recession and stuff, that was from 2022. Right now, we should be seeing expansion on the road ahead, whilst the rates are coming lower. What I found in my work over the years is I uncovered something that I refer to as the everything code, and which is a bit of a kind of hubristic title, but it was really shocked me. I think I was one of the first people in the world to find that what had happened back in 2008 was we had a global debt reset. As opposed to a debt jubilee where you don't pay any of the debts back, you had an interest rate jubilee. And so what happened is all of the major central banks and governments around the world agreed not to pay interest. That's what zero interest rate policy was. We kind of were sold that it was a story of we need stimulation. It was not stimulation. What it actually was a jubilee, and you don't need to pay your interest rates. Why? Because all of the governments around the world have got to 100% of GDP in debt. Now, when you're 100% of GDP in debt and you have an aging population, you tend to have slow GDP. So GDP, trend rate of GDP in the US is about 1.75%. Let's call it 2% for easy maths. And let's say average interest rates over the last 10 years have been 2%. So 100% of all economic activity goes to pay the interest payments on the debt. Issue is the corporate sector is over 100% of GDP in debt. This is the only game. Everything else is irrelevant. Every single asset class, every single economy, every single central bank is all highly correlated based on this debt cycle. Why this debt cycle? Well, back in 2008, everybody reset their interest rates to zero and then restructured their debts maturities at all government level from 3 to 5 years. So you've got a 4-year cycle, and it's perfect. It's also exactly what happened in the 1950s after World War II, because we had the same issue then, and we did the same thing then. And as opposed to zero interest rates, what we used then was yield curve control. But what they're doing is every time the debts come due, which is this year and next year, we've got 10 or 11 trillion in the US alone of debt to roll over. They print money in the form of liquidity. It's not just the balance sheets. Every aspect of liquidity you can find in the system, they understand the game. They all do it together. And they're doing it now. So liquidity is the driver. So when you start adjusting markets, this is the magical thing. Once you adjust the S&P 500 by Fed net liquidity, the largest measure of liquidity in the US, the S&P 500 has gone nowhere since 2008, 9, because it fell in 2008. It's gone nowhere, almost zero returns in real terms. Gold, same. Real estate is different because you use leverage, but if you would use unlevered real estate, it's gone nowhere. In fact, no assets have gone anywhere except 2. There's only 2 assets in the world that outperform debasement of currency. Debasement is the excessive printing of currency to pay your own debts, using a credit card to pay a credit card, for example. It's only technology, and it's only crypto.
According to Pal, after multiple rate cut announcements from the Federal Reserve and other central banks is what he describes as more cowbell. Pal believes it's a foregone conclusion that central banks will print heavily to prevent the complete collapse of the entire global financial system. The massive liquidity pump will spill into the markets, especially the cryptocurrency market, which is known for its insane volatility. We saw a little bit of that volatility after the rate cut announcement on Wednesday, as Bitcoin jumped from a 24-hour low of $59,212 to a high of $61,135, gaining hundreds of dollars within minutes of the announcement. When the printing starts, possibly in 2025, Pal predicts Bitcoin and other cryptocurrencies will experience even more volatility to the upside, with the leading cryptocurrency gaining thousands of dollars in a single day. This is the phase Pal describes as the banana zone, the part of every crypto bull market where prices get almost unbelievable as they skyrocket wildly or go bananas. Pal says, we are now witnessing the beginning of the banana zone, and there is so much more to come. Let's get back to the video.
So where we are today, well, liquidity being the main driver leads the business cycle. It bottomed in exactly the same time the NASDAQ and crypto bottomed, which was October, November, December 2022. And it's been going up, and those markets have gone up. The other and they lead because they follow liquidity. Most other instruments, the Russell 2000, oil prices, copper, they tend to be living in present day business cycle, which is today, which is just picking up. So you're starting to see commodities still rock bottom, starting to pick up. You're starting to see Russell 2000, you're starting to see the equally weighted S&P now all-time highs. You're starting to see that happening. So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity's coming into the market.
Over the next, I guess, 15 months.
15, and some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. Yeah. So we've got a really nice period ahead of returns that we can all call ourselves geniuses. Don't forget, step back, all of the noise you read, all of the stuff, rates are at 5.5%. Headline CPI is at 2.5%. Right? Rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great. And the cycle will repeat. 2026, the cycle slows down again. And then we go through the same debt refi cycle all over again. Oh, and the other function of this is financial conditions are also easing. Financial conditions, we find the best measure of financial conditions is the dollar, which has been weakening. It should do at this point in the cycle. Commodities, which have been relatively weak, which is great. Normally they'll start picking up very soon. And then rates, which will come lower. So we've got financial conditions easing, the Federal Reserve easing, most of the central banks easing. We've got stimulus coming from almost everybody. The Fed, less so yet. The Chinese are leading it because they've got the slowest economy. So it's all to look forward to. What's become obvious is I talked about this theme of debasement, and there is, I call it a supermassive black hole. Right, we're all used to, many of you CFAs in the room, and we're all in the investment world, and we're used to diversified portfolios. It's kind of a weird world. Everything's correlated to this liquidity cycle. They either lead or lag. That's it. That's all you've got. That's the only tools you've got to play with, unless you're dealing in alts. Even most alts are actually still correlated to the business cycle, which makes it a problem for people in how to think about this world. But I have done the terrible thing of just saying, well, if it's all correlated, I just want the best risk-adjusted asset class there is. And once you actually do the work on it, bizarrely enough, it's crypto. The most volatile, the thing that falls 80% every 4 years. Every 3 years, crypto is the best performing asset class. Every single year, every single 3 years, until the year, 2 years after the US election. This is this debt refi cycle, and it's always the worst. And in the worst, it goes down 80%. Most people would say that is an uninvestable asset. How can you possibly buy something that goes down 80% every 4 years?
It's been roughly 15 hours since the Fed's announcement at press time, and Bitcoin continues to show a lot of promise to the upside undoubtedly, as a result of the Fed's larger-than-expected rate cut announcement, and Fed Chair Jerome Powell's surprisingly dovish remarks. While speaking to reporters during his press conference, Powell described the half percentage point rate reduction as a recalibration of central bank policy, adding that the central bank will continue to make decisions based on future economic data. Powell also noted that he and other Fed officials do not see the rate cut announcement elevating the risk of an economic downturn. I don't see anything in the economy right now that suggests that the likelihood of a of a downturn, is elevated, he said. I don't see that, he continued. You see growth at a solid rate, you see inflation coming down, you see a labor market that's still at very solid levels, so I don't really see that now. As of press time, Bitcoin is trading above $62,000, its highest peak in almost a month. Do you believe the Fed's announcement will have further impact on Bitcoin and the rest of the crypto market? Please share your thoughts as well as comments on Raoul Pal's assessment of the current state of the crypto market and the overall global economy. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.